here on the India Development Debate. I'm Taneia Bhardwaj and we're coming to you live from our Mumbai studios. Sticking to the script today, the RBI's Monetary Policy Committee cut the repo rate by 25 basis points. It now stands at 6%. Remember, this is the second straight rate cut that we've seen under the new Governor Shaktikanta. Thus, the MPC has also decided to maintain its neutral stance. GDP growth projections for FY20 have been lowered to 7.2% from the earlier estimate of 7.4%. As is retail inflation, it's now being seen at 2.4% in the fourth quarter of FY19. Remember, it was earlier in the February policy pegged at 2.8%. The question we're asking today is, what does the MPC action really mean for the economy as we head into an election? The signals from Ministry, if you like, is the topic of discussion this evening on the India Development Debate. And for that, let me introduce to you our panel. Joining in, former Deputy Governor of the RBI, S.S. Mundra. We've got the former Secretary of Department of Economic Affairs, Mr. R. Gopalan, joining in. So does the former SBI Chairman, Pradeep Chaudhary, and Professor at SPGIMR, Anant Narayan, is here with us as well. Gentlemen, good evening to you and thank you so much for taking the time out. Mr. Mundra, let me begin by asking you, sir. The MPC voted 4-2 today to cut the repo rate to 25 basis points. Now, you know, of course, the rate action was on expected lines, but there is a view. Take, for example, the member of the PMEAC, Ashima Goyal, who spoke to us today, and she says that the RBI is behind the curve in cutting rates, and she was in favor of a 50 basis point cut. Do you believe that this rate action is too little too late?
First, we had two consecutive rate enhancement, in June and August. And thereafter, the third action was the change of stance to tightening, which continued for the another policy. And now it is suddenly, now it is followed by a rate cut, a change in stance in the previous policy, and another rate cut maintaining the stance. Now, the larger question which came to my mind, whether the circumstances surrounding us, our globe has changed so much, so much difference in policy thinking has come, or the data collection and data analysis methodology by RBI has undergone any internal change, or there is a fundamental change in thinking of Monetary Policy Committee. This was a natural reflection which was coming to me. Having said that, coming to your specific question, as far as the 25 basis point rate cut is concerned, it was an expected line. Even continuity of stance, I don't think that many were expecting it to undergo any change. But looking to whatever I have mentioned of the past history, and the fact remains that the RBI projections inflation is constantly undershooting it. Moreover, the risks which are mentioned, I think all those risks are always there in every policy pronouncement. If you are talking about the monsoon uncertainty, about the fuel prices, about the fiscal concerns, about the global events, these are not the new risks. Having put it all together, and even if there is a possibility of one of those risks materializing, I would believe that it would have been probably RBI had the room to front load the rate cut and should have gone ahead with 50 basis point cut, because there is a concern, and for the first time in the pronouncement probably growth is inflation is looking like a less worry at this point in time. Growth is getting the prominence. There is a room available if you look at the inflation rate and the policy rate. So probably this was an opportune time to front load it, go ahead with this. Maybe in coming months the room may not be available to that extent. So that is my take on the policy.
Okay. Fair enough. Mr. Gopalan, I'll come to you next. The 25 basis point cut was expected. Our own poll suggested it. But what one could say has left the market a tad disappointed is the fact that the MPC refrained from shifting to a more easy stance. Do you believe there was room to be more accommodative, or has the MPC pulled off what many are calling a fine balancing act at this point in time, given the circumstances?
I do believe that, keeping the neutral stance was correct for the reason that, the core inflation is still sticky. and there is a possibility that core inflation being sticky like this, it always I mean it is somewhat debated, but generally agreed that core inflation I mean hikes the inflationary expectations to a considerable extent, and the prevailing circumstances in the external front, oil, trade wars, growth, they were all not looking so good, and so we should look into and also the transmission itself for the past cut has not materialized so much, except 10 bips, 5 bips or some such thing in certain cases. So when you don't correct the transmission mechanism so much, and with these kinds of headwinds which are looming still there, and with expenditure programs coming up, the Kisan program and other things which other parties have promised, obviously the rural wages is likely to go up and rural incomes are likely to go up, which means which will apply a pressure on the prices and WPI, which can push up the core inflation to a level which is slightly higher. So all these taken into account, I get the impression that keeping at neutral was a correct decision of the MPC at this point in time.
Mr. Chaudhary, to you then, Mr. Gopalan talked about transmission. Explain to us what this will mean for borrowers. Should they expect interest rates to come off? Because, through the day today, every banker that we've sort of posed that question to, they've said, listen, the constraint to loan growth is deposit growth.
Absolutely. In fact, what the RBI is doing with one hand, the government has undoing with the other hand. Now, RBI claims it has lowered the repo rate, but you look at the small savings rate. They are at 7.5% for 5 years. Now, in this environment, how do the banks get deposit at lower rates? And it is not the PSU banks alone. Look at the private sector banks who are supposed to be epitomes of efficiency and enterprise. Even Kotak Bank and Yes Bank cannot get saving bank deposits unless they pay 6% interest. And even at these rates, the Indian interest rate, real interest rates are record high. 3% being the inflation and 6.25, even if you say 6% is the repo rate, which I think is a theoretical rate, it means nothing to nobody. It doesn't mean anything to anybody. So the real interest rate is 3%, and no wonder that we have such pile up of NPAs. So I think Reserve Bank is not taking upon itself the slum responsibility of catalyzing growth. They are just living in their own cocoon and saying that inflation is under control, so we have done a great job, and backpatting themselves. Now, inflation is down because of benign oil prices. It has nothing to do with RBI's lending policies. So this being the case, even this will not be transmitted. In fact, you forget the banks. Today I was on a panel with the HDFC MD, and he even didn't indicate that they are lowering going to lower the lending rates. Now leave aside the banks. What about HDFC? It's a sterling, performer in terms of transmission and whatever. Even they are not lowering the rates. And secondly, the NBFC sector is fighting shortage of liquidity. With the result, they have raised their borrowing rates. So unless the NBFCs lower the interest rate, there is no competitive pressure on the banks, commercial banks, to lower the interest rate. So I think this transmission will just not happen. And it is too simplistic to think that 0.25 I remove, lower the repo rate, 0.25 will be the lowering of the lending rate. It doesn't work that way, because repo rate is a insignificant, minuscule portion of the bank's borrowing cost, of the cost dynamics. Yeah. Main cost is the deposit cost, and banks in today's position are in just no position to lower the deposit rate.
Mr. Chaudhary, that's a great point you make, and I think a lot of viewers are going to sort of learn from that. And then since we're talking about, the shortage of liquidity, it was clear that the market at least went into this policy with bigger expectations on that front. Would you put into perspective for us, one, what is your assessment of, the RBI's toolkit so far to sort of replenish liquidity? And again, we didn't really hear the governor give out specifics on, what they're going to do to try and allay the fears that exist.
Well, Taneia, this has been an age-old problem. In fact, if you remember, even way back in 2015, when Dr. Rajan went into an accommodative mode, there was always fretting and fuming about why rate cuts do not translate into lower rates for borrowers, for you and me. And this is, I think, a lot of reasons go into transmission. It's not a simple subject, it's an involved subject. But one of the areas where I think RBI is kind of not using the right toolkit is deciding whether they want to have a surplus banking liquidity or not. Now, since 2011, RBI has maintained that it will always keep banking liquidity in shortage. What that means in simple terms is, in the beginning of the day, banks start off not having enough money to maintain CRR with the RBI, the statutory reserve with RBI, which means they necessarily have to borrow funds from the RBI just to make sure they maintain that statutory CRR. Now, because of that situation, it's like a carrot and stick. Banks tend to always look for deposits, always look to sell bonds, and not really worry about giving loans as long as you're short of that liquidity. And we've seen in the past, during the brief periods when banking liquidity goes into surplus, actually the reverse happens. Banks start to lend money, banks start to buy bonds, and they're not really concerned about raising too much of deposits. Now, I'm making it simplistic. There are lots of other factors, but I do think having this straitjacketed method of managing banking liquidity by perennially keeping it in deficit is a problem for transmission. And I think we need a liquidity framework that's a little more flexible, that doesn't say never, and instead allows liquidity to be modulated at surplus, neutral, or deficit based on the monetary policy actual stance. Right. That is missing today. Hopefully, where I'm taking heart is, while the governor didn't give specifics, he didn't rule out the possibility that we will go into a surplus liquidity situation. I'm hoping that based on the feedback from bankers about why transmission is not happening, we will hopefully see some over the next few weeks, some changes in the framework, and maybe transmission can be made better then.
Mr. Pradeep Chaudhary, do come in on that. Would you agree that transmission will become a lot easier if we see the liquidity situation improve?
Absolutely. In fact, if there was a 0.5% CRR cut, you would have seen a huge, the banks competing with each other, falling head over heels to reduce the interest rates. Because high interest rates is not very useful to banks, because this leads to lower profits for their customers. So banks are not happy with charging higher rates of interest, but they have to keep their head above water. And this kind of thing last time Dr. Raghuram Rajan, I think in his wisdom, tried to, micromanage things, and what complication he has made. He has made this base rate 1 month, base rate 2 months, now 3 months. Now, do you have money in this kind of jacket, in this kind of bracket, 1 month money, 2 month money? He has made it so very complicated without, easing it for the customers, but it has become a nightmare for the banks to in compliance. So I think that was a huge mistake, and RBI should roll back that this 1 month, 2 month, 3 month, 4 month base rates.
Mr. Mudra, banks have been asked to do more to transmit rate cuts. Now a set of guidelines is going to be issued for the transmission of rates. Should the consumer then take hope from the fact that maybe this directive from the RBI will come to their rescue?
No, let's understand one thing. The very fact that the linking of external benchmark to the lending rate, or linking of lending rate to the external benchmark, have been presently put on hold for the wider consultation. This itself is, giving an indication that just mandating something without having due regard to the liability structure of the banking system, rigidity of the system, can be counterproductive. So from that perspective, I think it had been a pragmatic move. So since this is already done, there is already a mention in the policy that there would be a wider consultation. So I don't think that it would be right to believe that immediately after this RBI would come with a framework and kind of mandate a transmission almost like automatic. I think there would be consultation. There would be some way which will be found, and the very fact that even before this policy, or even before the due date of this linking came, see, one of the largest bank, SBI, decided that part of its liability and asset, both they will link it to an external benchmark. But to my mind, these are the things which are we should be more come out of the market mechanism, of the understanding of the system, and this is how it should move forward. Because number one, there is always a lag impact, and it would never be realistic to expect that there is a policy cut of 25 basis point would automatically translate into a rate transmission of 25 basis point. It has never happened, it never happens. But to the extent that discussions can be done, a good framework can be evolved, and to the maximum extent possible transmission takes place, I think that will be the way forward, and that will come out of a very open and pragmatic consultation.
Okay, away from transmission, Mr. Gopalan, let's talk about something else. Both the MPC and then the governor also talked about is the fiscal situation that needs monitoring. Do you believe, given that we're headed into an election where, competitive populism is often the order of the day, this is going to be vital?
Well, let me answer a couple of questions on the previous points raised by them. One relates to liquidity. Well, liquidity, keeping it on a plus mode, will always be a good way in which the transmission on a reduction of repo can pass on. But there are some problems now on the external benchmark, which is a repo rate which you are using for the purpose of, banks deciding on what the rate is going to be. Look, the previous rates at base rate or your weighted average capital this thing or your MCLR, they are all asset based, which means that depends on what the cost of your funds. Now here you are going to fix external benchmark, which is going to look at something different, and banks are interested in NIMs for their survival, and if that is not going to gel with this, they will play around that external benchmark like SBI has done into a few other things and not into the whole structure of passing on a benefit of reduction. So this is one thing which for which RBI probably must be looking at deeper consultations. And as far as the question about a fiscal deficit is concerned, Mr. Chowdhury pointed out about the cost of the fiscal deficit, the borrowing, extra borrowings, which increases the supply and therefore increases the yield, and if that yield goes up, and obviously the way how the that yield will have an effect on your cost of funds, and therefore with the deposits not growing as much as the advances are growing, credit is growing, obviously credit deposits ratio at the margin being very, very high, your transmission is going to be very, very difficult. Coming to a fiscal deficit, yes, there is a belief, and I also hold the view that the revenue projections in the next year's budget are somewhat optimistic, more optimistic I would say. Now if that being the case, obviously the fiscal deficit numbers which they are talking of may have a problem, and if monsoon is not going to do well, now more expenditure will be incurred, and obviously incomes will not kind of flow, and therefore the revenues will also not flow. So the question that will happen is that the fiscal deficit we'll have to look at that very, very seriously, how to contain that. Now you can contain it by reducing capital expenditure, which is not going to help the productivity of the economy. So these are all problems which will hem in from all sides. Now one needs to see how we are able to pan out based on external situation and domestic situations, and then only we can take a call. But today I totally understand, I clearly agree with you that fisc is a problem. Though the governor says requires monitoring, I would say it's a problem.
Okay. Anant, this is a dovish statement, both in terms of, growth and inflation. And to that extent, I think everybody would agree that we do see some sort of space for more rate cuts. But when are we going to see it? Because, again, it's going to be vital, as Mr. Gopalan said, to see, for example, how the monsoon pans out. You've got oil prices. You've also got, we're looking at a new government, which will then present its budget in July. So when do you think we're going to see action on the rate front next?
Well, Tanya, to start with, I guess, given the projections on CPI and GDP, it's fair to assume that one more rate cut would come through. It might be tough bringing it in the June policy, because in July you have the budget, and the MPC might want to wait for the budget to see what the fiscal numbers look like before they actually take action on the monetary front. But one thing I'd like to caution is the following. Look, yes, we need transmission of lower rates and we need better tools to manage transmission. That's a more generic framework related problem. The bigger question we have to ask ourselves is is lower rates and is better transmission the solution to the nation's problems today? It's tempting to think that, given that growth seems to be slowing down, unemployment is a cloud, and we don't really know what's happening on the overall framework. So we think it's good to have lower rates. But I would caution against that. One, the point you made about the fiscal. I think the fiscal deficit is far higher than what the headline suggests. And there's a lot of accounting smoke and mirrors going through to hide the actual number. And past occasions of fiscal slippage along with monetary easing have left us vulnerable to financial instability, and we don't want to repeat that story. Second, we don't know where crude oil prices are heading, and that could be the external trigger for us to actually trigger off financial instability. Third, core inflation remains high. Fourth, as you rightly mentioned, every political party seems to be promising the moon as far as fiscal spending is concerned. Given the situation, I don't really think this is the right time to rely on monetary policy easing to actually give relief to the economy. After all, sectors like power, for instance, which are stressed, do you really think interest rates can solve the problem there of fuel supply agreements, of power purchase agreements, of discoms not paying them money? This has nothing to do with monetary policy. So I think rather than looking for short-term palliatives in the form of lower interest rates, we've got to look at deeper reforms. We've got to take a stronger look at our fundamentals like fiscal deficit, etc., and sort them out rather than waste our time on monetary policy. But absolutely, we need the toolkit for the RBI to manage transmission better, and liquidity management is a strong toolkit which can go in conjunction with monetary policy.
Right. Mr. Chaudhary, we have to talk about the February 12th circular. The governor today has said that the RBI will issue a revised circular on, resolving non-performing assets. Let me ask you, what would you like to see in it that ensures that the bad loan cleanup process isn't compromised?
No, one circular cannot do that. But I think this is possibly a result of, Supreme Court's unhappiness with RBI's arrogance. Now, Allahabad High Court mandated the Ministry of Finance and Ministry of Power to put together a mechanism or to sit around the table with oil ministry or rail ministry, coal ministry, banks, and even invited RBI to see if there is a way out possible. Now, RBI, look at that, they didn't even send a representative. You could have as well sent a representative and said, sorry, I can't agree on this because we are a signatory to Basel III, so we cannot write our own rules about asset classification. But look at RBI's disdain for this, consultative process. Now, if you do this to the courts, this will be the results. So, I think RBI has to be more, in the listening mode, and which they are not at present, and then extending that further, they have to talk with all the stakeholders and then arrive at a acceptable kind of a resolution.
Okay. Mr. Mundra, last question to you. Sir, this is also the first time that we've seen the RBI admitting that private investment is very sluggish and there is a need to strengthen growth. I mean, if you look at some of the high frequency indicators, take, auto numbers, for example, they're sort of, starting to show the pain on the ground. GDP growth has also been revised downwards today. How big a worry is all of this, given that we're also now staring at a weaker global environment?
No, it's a genuine concern, and I think it's a very right and positive indication that various stakeholders, whatever they are required to do, should be aware of that and should be responsive to that. But having said that, monetary policy alone cannot do that job on its own. It has to, several components which have to move and fall in place. And I think for example, if we take the recent developments and the Supreme Court pronouncement and the position of the power sector, but the fact remains that if we pick up, say, one power sector and there are related issues around that, if those issues are taken care of, certainly it will contribute to the growth and to the private sector investment. There would be similar specific individual issues in various sectors. So I think they would need to be dealt with in totality, and yes, to the extent that monetary policy can support that, I think the stance of monetary policy now has been modulated in that direction.
All right, great. With that, I'm afraid we're out of time. So I'd like to thank each one of you for taking the time out to chat with us this evening on the India Development Debate. Mr. S.S. Mundra, Mr. R. Gopalan, Pradeep Chaudhary and Anant Narayan. Thank you, gentlemen.